as far as small caps go, they had the biggest move that they've had. First of all, you know, just in terms of raw, price percentage move, they had the biggest move in several decades. But they also about 2 weeks ago had the largest outperformance versus the S&P 500. In other words, they didn't just move up a lot, but they moved up more than the S&P 500 by a magnitude that goes back like I think 55 years. So small caps have suddenly sprung to life on the promise of rate cuts because small companies generally are less mature companies, so they need constantly to borrow money. So lower rates help them, obviously. And then the other thing is because they don't yet have earnings, those future earnings are worth a lot more today as rates come down, which means we can afford to pay more for the stocks.
Welcome to Wealthion. I'm your host, Andrew Brill. Is it time to start putting some of that money that is sitting on the sidelines to work? We'll answer that question and some more right now. I'd like to welcome Adam Johnson back to Wealthion. Adam is the portfolio manager of the Bullseye American Ingenuity Fund and author of the Bullseye Brief Investment Newsletter. Adam, welcome back. It's always a pleasure to talk to you. You're always upbeat, whether the market is soaring or tech stocks are plummeting.
Yeah, and there's been a little bit of both over the past week. I mean, isn't it just amazing how quickly the narrative changes? Everyone's been talking about how wonderful rate cuts will be, and then we finally get confirmation from Jay Powell. Yep, looks like September we're going to get cuts. And then all of a sudden everyone says, oh my gosh, this is terrible. Are we going into a recession? And why is he waiting till September? Right? I mean, it's like, damned if you do, damned if you don't. So, the volatility's been intense. But I am someone who generally believes you go against the grain. So on days when my beloved semiconductor stocks are down, I'm buying them. And, I guess the corollary is when they run and maybe get ahead of themselves, peel a little bit off. But I'm not really a trader, so I tend to just kind of ride out the volatility. And I'm trying to generate long-term gains for my clients. So that's my approach.
We're both here in New York City, and it is hot as blazes today, and I want to commend you. Your walk and talk this morning, if you haven't seen it, check out Adam on Twitter, but a shirt and tie walking to work through Central Park, you're brave. I'll peel back the curtain a little bit for our people. I take the subway to work. I wore a polo shirt, and because of today's humidity when I got here, yeah, I was soaking wet. So, kudos to you for being able to walk in a shirt and tie through Central Park.
Well, what you don't realize is I was on my way down to Fox Business to join Stu Varney for his show at 9:00. I got there about 8:15, and I was completely soaked through my shirt. And one of the makeup gals basically brought out a hair dryer, put it on cold, and then just blew cold air on me for 10 minutes because I couldn't get in front of a TV being soaking wet. So yeah, it's a crazy time.
You did look great in your walk and talk, though. So where do you see the economy right now? Obviously, Powell left rates where they were, but did indicate a rate cut coming in September.
Yeah.
According to your tweet this morning, all the indices coming back under 3%, except for the CPI, which is right around the 3% level. Where do you see the economy at this point?
Yeah, so there are a couple different components to the economy. I think that we need to consider equally in order to paint a fair and balanced picture. Starting with inflation, right? There are four primary measures of inflation: consumer prices, producer prices, personal consumption expenditures (PCE), and then the GDP price index. If you average all four of those together, as you just pointed out, that's 2.6%. The Fed's target is 2, and you say, oh, well, that means we're still 0.6 above it. Yes, but CPI was as high as 9.1, and PPI was as high as 11.3. So we are way down, and arguably we are very close to the Fed's target, which I think is why Jerome Powell has said, yeah, it's probably time to cut rates. I mean, if you're within 0.6% of the target and you took rates from effectively 0 up to 5.5, it makes sense that you would take back 1, 2, 3, who knows, at some point, maybe even 4 of those in kind of 25 basis point increments. So it's gradual. So yes, inflation is coming down. That's foremost and very important. Number
Look,
two, yeah, I'm
go ahead.
sorry.
Go ahead. Go ahead. Go
Yeah.
ahead.
Number two, growth. GDP, we just found out through the most recent data, is rising 2.9%. Well, that's pretty good. In fact, that's above the long-term average of 2.7%. So if we have inflation coming down and we have growth going up, that's a good combination. The third component is employment. And there it's maybe not as crystal clear because it's been at close to 50-year lows, and it's unemployment starting to percolate, which is one reason why Mr. Powell is saying he wants to cut rates, get ahead of that. While fewer people working means that there's less inflationary pressure, it also means that fewer people are working, and that's not great. So, for now, I think when you look at the data in its totality, inflation coming down, growth going up, and unemployment still really low, 4.1%, or thereabouts. That's a pretty decent combo, and I think it's why earnings, and that's the next sort of point in this conversation, that earnings, that's why they're up 10%, which is higher than the previous quarter, which was 8, and the quarter before that, which was 7. So we're steadily seeing an improvement in earnings. And so for all those reasons, I feel good with where the economy is. I feel good with being fully invested. And I feel good with Chairman Powell's decision to start reducing rates.
Can you explain to me, and I know that nobody's got a crystal ball, what is this volatility we're seeing? Everybody thought that, look, rate cuts, great. We're going to pump money into the market. You've said that, lowering rates will increase, the market. It's good for the market. And
Yeah.
all of a sudden, people are selling off like crazy. We saw it early in the week. Last week, sell-offs in tech. Everybody's buying small caps. And then yesterday, good news from AMD, and all of a sudden tech, boom, it pops. And now it's the whole market today, Thursday, as we record this, is plummeting again.
Yeah, I
What
know.
is going on?
I know. Wednesday it was one of the best days in months, and the next day one of the worst days in months. And then to put a little bit longer term perspective on that, I mean, isn't it amazing that actually, effectively, in the first, call it 2 weeks of July, the Nasdaq dropped 9 percentage points, the S&P 8 percentage points. Drill down a little further, Nvidia, everybody's favorite play for AI, has fallen 23% in 3 weeks for effectively the second time in 6 months, right? So what I think's happening is that you have massive computerized programs, algos, right? That's what everyone likes to call them, the algorithmic traders, who've been programmed to trade certain levels, and they trade those levels. So if stocks get to certain price points, and that may be determined by the actual price or by volatility bands or by money flow in or a percentage move over X period of time, whatever. There are all kinds of ways, different ways to program these algos. But they hit these stops, and then all of a sudden the computers just sell. And then investors look and say, oh my gosh, what am I missing? No, you're not missing anything. It's the computers have predetermined sort of bands where you should buy and bands where you should sell. And we are in the midst of all of that. In fact, the New York Stock Exchange estimates that as much as 3/4 of the trading on any given day is programmatic trading. It's not smart people sitting around the table and say, hey, what do you think of the AMD earnings and how they compare to Intel and, NVIDIA's coming up in a week and a half. That's not what it is at all. It's computers that are programmed to look at the, let's say, 7 essential metrics on any given earnings report. Top line revenue growth, right? Gross margins, net margins, the actual earnings themselves, right? Guidance, right? All these different metrics. And let's say 6 of the 7 are strong, but one of them is not. Well, guess what? The algorithm automatically shorts the stock. And because you no longer need a plus tick to short the stocks, all of a sudden it's down 10, 11%. And you say, well, that doesn't make sense. And you listen to the earnings call and you read the press release and you say, yeah, we should be buying that. And it takes a couple days. So we're just that's what we're dealing with. It's kind of man versus machine. And then I guess the other thing is people, and we kind of touched on this, are saying, wait, what's Mr. Powell? What what does he see? Why is he lowering them now? I mean, is there something bad on the horizon? And that just gets all kinds of people nervous. So take the long view, recognize computers are messy, recognize markets move, and just pick wonderful companies and have the confidence in your views and in your process, because you did the work that got you there in the first place. Have the confidence, just hold the stocks through all this noise.
So those are probably big corporations that rely on those algorithms. I almost equate it to baseball, and I go way back with baseball before analytics was even a
Right.
thing. And sometimes you say to yourself, "Well, the manager doesn't. What does the manager do anymore? He's relying on they used to call it the book. Well, the book says you don't swing 3-0. Now people swing 3-0. It's almost like we're relying on these computers to take care of all the analytics for us. Is
Yeah.
that a dangerous thing? Because you don't do that. You see it,
Yeah.
you watch charts and graphs and say, okay, you know what? This is a great buying opportunity. Like you just said before, you said, I'm adding money to the market right now.
Yeah. Well, take one of my favorite names, Celestica, ticker CLS, and I'm just pulling this randomly. I could make this kind of argument about any number of names, but Celestica, call it a week and a half ago, beat earnings estimates handily on both the top and the bottom line, raised guidance. The stock went up 7 or 8%, and then suddenly it traded down, and now Celestica, by the way, partners with NVIDIA to create AI platforms. So, if you and I wanted to start some company and we wanted AI to be a part of it, we would go to Celestica and say, we need to create this platform. And they would source the NVIDIA chips, they'd source the servers, the workstations, they'd wire them all together, they'd put them on a rack, they'd get coolers so that they don't overheat. They would literally create the whole hardware, and then they'd show up at our office, install it, and we're in business, right? That's Celestica. So wonderful results, but because it's caught up in this AI trade, where all of a sudden everyone's saying, "Oh, the trade's over." No, it's not, but that's what they're saying. So here's a company growing gangbusters that just beat estimates, that guided up, and then it's suddenly trading down 20%. And by the way, trading at 13 times earnings, an AI related company at 13 times earnings that's growing double digits, that doesn't make sense. That's when you buy. And so that's why I say you just, you have to do the work, you have to know your companies, and you have to have the confidence in your view.
So I do want to ask you about, the rate cuts and the market, and how slippery is the slope for the Fed? They're trying so hard to make this a soft landing. And, with the unemployment numbers that ticked up, and you really have to read between the lines with the unemployment numbers that came out, because a lot of that unemployment came from Michigan. It's a seasonal thing where at the end of the summer, they take off, they lay off some workers, and then they bring them back. And also Hurricane Beryl added to that too. But nobody looks at that. There's, oh my God, unemployment ticked up. We're recession bound. So how slippery is the slope for the Fed to help try and create a really soft landing here?
Well, I think actually the Fed has done a reasonably good job, and no one likes to give the Fed credit because the Fed's an easy target. It's easy to just say, "Oh, the Fed's always late." They keep rates too low for too long, and they keep rates too high for too long, and that's the problem. It's not that any of us made a mistake, right? Or any of my companies or the CEOs I believe in. No, it's the Fed. So I think the Fed takes an unfair amount of heat, but I do think, as you suggest, they've done a reasonably good job at threading this needle, and I do think maybe they've held on a little too long. I think they probably could start lowering rates, but I don't think 6, 7, 8 weeks make a whole lot of difference in an economy that's $23 trillion, especially when the rate cut's only going to be 25 basis points. So yeah, okay, maybe they've held on too long and they should be cutting. Fine, they'll be cutting soon enough. And by the way, GDP was a lot higher than we thought at 2.9%. So, it's not like all of a sudden there's no inflation.
There's talk of obviously interest rate cut. A lot of money, they say, poured out of AI and semiconductors and into small caps.
Mhm.
Would you consider that a decent play right now? Is look at some of those stocks, or is it still look? Maybe some of those little stocks have an AI background also, like Celestica that you talked about.
Yeah.
Are there stocks like that you would take a look at?
So a couple of comments. And being a stock picker, I think it's most important that you focus on individual stocks, not the market, not sectors. I appreciate themes like AI or computing power, but um, you got to know the company or the 4 or 5 companies that are part of that theme that is part of your portfolio, and so you have to really do the work on individual companies. But um, as far as small caps go, they had the biggest move that they've had. First of all, you know, just in terms of raw, price percentage move, they had the biggest move in several decades. But they also about 2 weeks ago had the largest outperformance versus the S&P 500. In other words, they didn't just move up a lot, but they moved up more than the S&P 500 by a magnitude that goes back like I think 55 years. So small caps have suddenly sprung to life on the promise of rate cuts because small companies generally are less mature companies, so they need constantly to borrow money. So lower rates help them, obviously. And then the other thing is because they don't yet have earnings, those future earnings are worth a lot more today as rates come down, which means we can afford to pay more for the stocks. So that's really why small caps rally. Yes, that is a very viable trade. Small caps are still well below their all-time high that goes back to, I think, 2021. And so there's more room for them to run because the S&P and the Nasdaq have just recently made new highs. Nasdaq or the small caps are still catching up, but I would also caution viewers and listeners against simply buying small caps because they're small and it's a hot space. No, you got to find high quality companies, and by high quality I mean good management teams, a good product. Maybe they have pricing power. The barriers to entry. They don't have too much debt. They're growing cash flow. Ideally, they have earnings, right? I mean, there are a lot of different ways to sort of define quality. Those are a few of them, and I think all of those are important in making a decision about a company.
Can you explain how the rate cuts help companies that are the smaller companies? Obviously, the big companies have their own cash and they use that cash. And then I'll have another question about what Netflix just did. But how do the rate cuts help these smaller companies?
So, if you're a small company, you're small because you're still growing your sales and trying to get them above a certain threshold. And chances are that means that you, every few quarters or maybe every year or every other year or whatever it is, need to go out and borrow some more money. You might do that through a secondary stock offering. You might do that through a bond offering. You might do that actually from just, taking out a loan or a line of credit or what they call a revolver. It's a revolving credit facility where it just kind of sits on the shelf, and as you need it, you pull money down and then you pay it back. And then as you need more, they rotate it and you bring in fresh capital, right? That's a revolver. So if rates are coming down, by definition, the cost of all of that borrowing is also coming down. So it's easier on the company, right? It's cheaper, it's cheaper money. In the same way that when mortgage rates come down, you can afford to buy a bigger home, or you just buy the same home and it costs you less. So you can, use the money that you saved and, go take the family for a vacation, whatever. So lower rates in terms of cost of borrowing, that's pretty simple to understand, right? It's just cheaper to run or finance your business. Fine. But I do think, and this is maybe what you're getting at, and I touched on it, but I'll say it again in a sort of slower way. And it's a subtle thing, and it's kind of in the weeds, but our folks need to understand the notion of a discount rate. So analysts like you and me, right? We look at a company and we say, okay, what do I think earnings will be next year, and then the year after that, and the year after that, and the year after that. And what I do is I put together this stream of what I think will be future income. But I have to discount to put it in terms I can understand today. I have to discount those future cash flows back to the present. So $10 next year at a 10% interest rate is like $9 today. So if you pay me $9 today or $10 next year, at a 10% interest rate, it's kind of the same thing. But all of a sudden, if interest rates drop to 5%, oh wow, now I'm better off because actually it should be $9.50. That's the right. So as that discount rate gets smaller, you can afford to pay more for stocks. Future earnings are worth more today. That's what a discount rate ultimately determines. It's bringing tomorrow's money into today's dollars. And again, as interest rates come down, that discount rate goes down, which means the value of those future dollars goes up.
This show is sponsored by BetterHelp. In these crazy times we live in, it's probably the last thing on your mind, you and your self-care. We all deal with it: work, kids, obligations, bills, you name it. Everything takes priority except you. If you've ever worked out or been an athlete, you've heard the saying, never skip leg day. But how about never skipping therapy day? That's right, I'm talking about taking care of you. Talking to someone who will help ease some of your burden so you can get back to what it is that makes you happy. I talk to a therapist, and it really helps to take the edge off everyday life. Maybe you're going through something and can't really pinpoint what it is that's bothering you. If you need to talk to a professional or are thinking about giving therapy a try, give BetterHelp a try. It's easy, entirely online, convenient, and flexible to fit your schedule. Just fill out the questionnaire and get matched to a licensed therapist anytime. Never skip therapy day with BetterHelp. Visit betterhelp.com/Wealthion today to get 10% off your first month. That's betterhelp.com/Wealthion. Netflix, and not in the AI, although they do use AI
Yeah.
because they're always recommending some sort of, every time you log on, oh, you watch this, watch this. So, but Netflix just did something very interesting. They issued investment grade bonds
Mhm.
to raise capital. How does that work? And is that, or should more companies be doing something like this when they need to raise capital?
Well, you could argue that raising debt is cheaper than raising equity because if you raise equity, you dilute your earnings per share. If you have X number of shares and you do a secondary stock offering and increase the float by 10%, well, by definition, you just lowered your earnings per share by 10% because you're now dividing the earnings by more shares, right? And so some will view that as value destructive. The other thing is, or the other advantage to bonds is, you can deduct the interest on bonds against your taxes. So not only do you get the financing, you don't dilute your shareholders, and you get the interest rate deduction. So your after-tax cost of borrowing is lower than the nominal interest rate cost of borrowing. So for some companies, actually, that does make sense. The other thing is for investment grade companies, as opposed to companies that aren't investment grade, which are, they have to issue junk bonds, but investment grade companies, they issue investment grade, which carries a lower interest rate. So it's much cheaper than issuing junk bonds. And so, that can be very attractive because it's a low rate. And I should point out right now, that even though rates are still high, corporate bond spreads are at record lows. In other words, bonds trade at a differential versus the risk-free rate or treasuries. So if treasuries, just to make the math easy, are at 5%, and the spread for corporate bonds is 1%, well, then the total cost of borrowing is 6%. 5 plus 1, 6%. That 1% is the spread. Well, that 1%, and that's about where it is right now, is the lowest it's ever been. So even though rates are high, bond spreads are low, and so there, for all those reasons, that's why a company like Netflix is issuing debt.
So where does someone find out about those bond sales? Let's say, you know what? Netflix is a good company. They're trading in the $600 range. I think they're good for the money. They're going to pay their debt. They're raising this money, obviously, because they want to do something constructive with it. How do I find out about these bond sales and get in on this action?
Well, you need a broker. It's a lot easier for the public to buy stocks than to buy corporate bonds, which is ironic because the corporate bond market is so much bigger. But the corporate bond market tends to be a pros market. I think for people who actually want to trade corporate bonds, and I hate to say trade because I should really say invest in corporate bonds. I actually think they're better off looking at some of the ETFs out there. And you could just Google ETF, exchange traded fund for bonds. And what you probably find is that there are 24 super liquid, very transparent bond funds that will effectively forward all that interest income to you because you own a little tiny sliver of those bonds through the ETF. And I think that's the better way to do it. I mean, yes, you could go to a full service broker. You could go to Schwab, and Schwab probably has a page where you'll see a bunch of liquid bonds and you could buy them. Okay, fine. But if you want to find some of the more esoteric stuff, that's kind of a pros market. And I'm not sure that small retail investors should be messing around. I think they'd be better off just in an ETF or a bond fund.
I heard you on WABC radio. You said, you know what? I'm putting more money to work now. Now we know that there's $6 trillion, or there was at least $6 trillion sitting on the sideline in money market accounts, because obviously money market accounts getting good interest as the rate goes down. Do you see that money getting put back to work?
I'm shocked that it hasn't already been put back to work. I mean, I really am. Right, 6.1 trillion. That's the most ever in terms of just raw dollars. It's also the highest as a percentage of investable assets, about 23%. So it's at a record high no matter how you measure it, raw dollars or as a percentage of assets. And so I'm just amazed that there are so many people who are still so afraid to put their money to work. And what's really sad is that they've missed a huge opportunity because markets have been up so much over the past, 12, 13, 14 months. But investing's not hard, or investing's hard, and it's not for everyone. Some people just want the security of knowing they have cash, and I get that. I think probably the smart approach is to always have some money in the market, and then have some cash as well, and you just vary the percentage. You can shift back and forth depending upon your risk tolerance and what you think of the economy and the market at any one time. Yeah, I've been putting money to work. I mean, on a day when stocks are down a lot, I sort of say, oh, geez, I wish I had waited until today. But look, no one's that good. No one ever picks the bottom, and no one ever sells at the top. It's just not the way life works.
Do you look for a percentage? And it's funny. When I was younger and just starting out, I had a broker who called me and said, hey, you know what? Why don't you put some money in this stock? 3 days later, he said, it's up 10%. We should get out.
Oh,
Is
no.
there a rule of thumb you now,
No.
I'm talking 30 plus years ago, but is there a rule of thumb you look at or you're like long term, let it ride, and here we go?
My rule of thumb is before I buy a stock, I set a target. Because as my longtime mentor said once, you're only rational once, and it's before you buy the stock. Because once you own it, you fall in love, right? So set the target in advance. And when the stock gets to your target, sell half. Doesn't matter how strong it is, how much you love it, just sell half. It got to your target. Fine. And then decide what you want to do with the other half. And the way you figure that out is rerun your numbers. And if you can comfortably raise your target, then hold the balance. And when the balance gets to that target, again, sell half. Or if you can't justify raising your target, say, you know what, maybe that's all there is on this one, and then go redeploy the money somewhere else. So no, there's no rule of thumb whereby I sell if it's gone up X amount, but there's a very important rule, and it's not a rule of thumb, an important rule where you sell half the position whenever it hits the target.
So we have that going in. Don't make that up as you go along.
Yeah.
You're going to have that target before you even go in.
And by the way, when you have that kind of process in place, it just makes life easier. Oh, hit my target, sell half, boom. Okay, now what am I going to do with the balance? Well, market's getting a little expensive. You know what? Then I'll just sit on that extra cash. And over here, I've got my watch list group of names that, if they get to a certain point, I'll buy them. I should also note, on the downside, it's equally important to have, I don't want to say a target because you don't set a target for it to go lower, but an alert is what I call it. And for me, that's typically down 30 or 35%. If I'm long a stock that's gone down that much, I stop and say, yeah, this isn't working. What's wrong? Have I missed something? Has something changed, or is it just the market? If nothing's changed and I'm really confident, I may stay with it. I may even add a little bit. But from time to time, it'll go down 30, 35. I say, it's just not working. Let it go. There's something wrong that I don't understand, and I got it wrong.
What have you thought about this earnings season? Has there been any surprises? There's a lot of companies that are doing very, very well, have good forward guidance,
Yeah.
and then they get clobbered anyway, which doesn't make a
Sell
lot
the
of
news.
sense.
Yeah, that's the typical old Wall Street saw about, sell the news. If a company comes out with great earnings and they guide up, you've always got those people saying, yep, that's as good as it gets. Just what we thought. It's like your guy said, oh, you're up 10%, 3 days, sell it. you know um, and so there are always nervous people who are going to say, oh yeah, I'm just going to book the gain. Nervous people never get rich because they think about where they bought the stock, not where the stock is going. So they're always playing defense and trying to preserve their gains rather than thinking about how much they could gain in the future. Not to get giddy about it, but that's the downside of looking back over your shoulder and looking at where you bought it and whether you have a gain. So I think that's a real pitfall that people make.
Where do you see, or where would you tell people is the best place to get information when they're looking for guidance on exactly what you say? Okay, you know what, I'm going to buy a stock, but I want to have my out price where I'm going to sell 50. So where do I go to find that information, or the information that will educate me on that stuff?
Well, I think information is about accumulated knowledge. So I'm not sure there's any one place where you can go and look up, where do I sell, right? But what you can do is start to build your own body of knowledge. And I think a great way to do that is to subscribe to two publications, the Wall Street Journal for one, um, which is just so laden with information and insight. I mean, you read the journal for a month and you will just feel smarter, you will sound smarter, and you'll start connecting dots in a way that you hadn't before. And number two, buy subscription to Investors Business. It used to be called Investors Business Daily. Now I think they call Investors Business Digest because the paper copy only comes out once a week. But they have several great stock lists: the IBD 50, the long-term IBD 20, et cetera, IPO leaders. And while it's slightly more technical in nature, meaning it's looking at price levels and money flow and as opposed to earnings growth or the products that are made, I think it just puts the market and then individual stocks into context. And so I think the combination of the Wall Street Journal for fundamental information and IBD for technical information, I think that combination makes for a very strong learning platform. And yeah, as I say, to anyone new to this business or just new to investing, read each of those for a month, and I think you'll be amazed by how far along you've come.
Aside from tech, Adam, is there something else that you're keeping your eye on? Obviously, AI and there's the tentacles are starting to really, really reach deep. Is there something else you're keeping your eye on?
Well, I think there are all sorts of opportunities out there. I mean, I love logistics. Companies that are focused on helping other companies deliver stuff more effectively and more cheaply. Robotics and automation play a huge part of that. I think there's still a lot of companies, great American companies, that are normalizing after the craziness of COVID, that still haven't quite gotten back to where they ought to be, whether that's Blackstone, world's largest private equity company, or Chubb, the largest and highest quality insurance company here in the US, though it recently did make a new high, but it's very cheap at like 11 times earnings. Um, Delta got clobbered on those earnings. It's a one quarter thing because they have 3% too much capacity. Fine. We had the most number of people ever transiting through U.S. airports July 4th weekend. So consumers have money. They're spending. Ditto on Expedia. DraftKings comes under what I would call my new mousetrap category, where they're taking something that we've done for a long time, bet on sports, and packaging it in a different way and making it more accessible. I think that's got a lot of upside. Um, Uber is kind of half logistics, half consumer, and they're going to build out their advertising platform because think about it. When you order an Uber and you're just staring at your screen, where is it? Where is it? Oh, there's the car. Okay, 2 blocks. It's coming. You're staring at your screen for 3, 4, 5 minutes. You're captured eyeballs. So put ads on there, and if you just run the numbers of how much they can generate for those ads and how many minutes people spend looking at the screen and how many people are looking at the screen in a given day, you can easily get to $2 of additional earnings within 2 years. Well, all of a sudden, Uber's earnings just went up by 50%. Stock just got cheaper, right? So there's some really exciting opportunities like that. It's not all just tech.
So I have to ask you about geopolitical tensions and how it's going to affect the market. A Hezbollah person was just killed by Israel, and they're still after Hamas. Obviously, tensions in the Middle East are getting higher, which means there could be an oil issue. How do you view the geopolitical tensions?
Pretty interesting. There hasn't been an oil issue already, though. I do think that if we didn't have war in Ukraine, if we didn't have war in the Mideast, if we didn't have tensions around Taiwan, my guess is that oil would be trading in the low 60s instead of the low 80s. So there is a war premium baked in. And remember also, even though the U.S. is pumping the most ever, the Biden administration has been very restrictive on drilling on federal land, and that's where a lot of the cheapest oil is. So that too, I think, you talk about political outcomes. If Trump gets in office, he's going to lift all those restrictions. We're going to have more cheap oil. Not just more oil, we'll also have more cheap oil. So the price of oil will come down, I believe. So oil is probably a little higher than it ought to be right now, given the fact that Russia and Iran are both exporting barrels. Venezuela is too. Incredibly, they're allowed to. Not in my backyard. Biden administration would rather have Nicolas Maduro, in Venezuela, the dictator of Venezuela. Rather, let him pump. We in America, we're clean. We don't, right? I mean, there's a
Yeah.
certain disingenuity about that, but fine. I think gold is probably elevated for a similar reason, geopolitical concerns. Maybe even you could, make the argument that Bitcoin is elevated, trading in the high 60,000s, geopolitical concerns. It's outside the realm. So there's no question that geopolitics put people on edge. That may be, in addition to the rate cuts, why over the past week or two, we have seen yields on treasuries go down. When there are uncertain times, when missiles are flying and accusations are coming out of the Mideast about going after Western countries, people get scared. And when they get scared, they buy U.S. treasuries, and that pushes yields down. So, that's definitely being reflected in the current market.
So the bottom line: do your homework, put your money to work,
Mm-hmm.
because now is a good time. How
Yeah.
do you see the presidential election affecting everything? I know that there's two sides of the coin, but it seems like Kamala Harris is now a little bit more aligned with some of the things that President Trump would want to do, but it's still Democrats versus Republicans. We still have 3 months before we get there. How do you see the markets playing out to that point?
It'll be messy and it'll be volatile. And if if what we're seeing right now proves to be just a sort of honeymoon bounce for Team Harris, and Trump starts to take the lead again, I think markets will take off. If, however, it's a dead heat, or if she starts to take a lead, I don't think markets will like that because she historically, if you just look at a record, historically, she is much more of a Bernie Sanders, Elizabeth Warren, high regulation, high tax type of politician. And, markets don't like that. Markets like independence. They like low regulation. They want government out of the way. That's Trump. So the market will sort of tell us who's leading. We can look at the polls, but polls are kind of quirky because they're polls. Whereas if you look at where the wisdom of the market, where people are putting their money and placing their bets, that ultimately I think carries more weight than just someone being asked to respond to a poll on a telephone call. So the markets I think will start to tell us. But right now we're still in the honeymoon phase. The DNC hasn't even had its convention. So, you got to get to September. The amazing thing is how quickly they pivoted from Biden to Harris, how she's been anointed without having to do a single press conference. We don't really know what she stands for. So that's why I say it's kind of a honeymoon period. You just sort of assume, oh, well, this is what's going to happen without really knowing the substance behind what's going to happen.
Yeah, you kind of think it's Biden 2.0, but we don't know. You're right. You're
Oh,
absolutely right.
I think she could be far more radical than Joe Biden. Again, based on her track record.
Right. We will have to wait and
remember, see. She was the one who said we need to reinvent policing in America.
Yeah.
That's not just defund the police. That's reinvention. She's the one who said we need to rethink the entire border. She's the one who initially said, I completely oppose all fracking. Now she realizes she needs Pennsylvania, and she's saying, no, fracking's not all bad because Pennsylvania has the Marcellus Shale, and there are 123,000 people involved in that industry, and that's a lot of votes, and it's a swing state. So, election year promises. So, just watch what they do, not what they say.
Exactly. Well, Adam, thank you so much. I appreciate you joining me, and I appreciate, and if Adam and I had some internet issues, so we took a little longer to get this done than we wanted, but I appreciate it. So other than the Bullseye Brief Investment Letter, where else can we find you? I find you on Twitter, so give us your Twitter handle so everybody else can see your walk and talks through the park in the morning.
Yeah, at AJ Insight is my Twitter handle, and I put all those 45-second walk and talks on Twitter. LinkedIn, interestingly, I get more traction on LinkedIn than I do on Twitter. And, Twitter, I got, 30,000 followers, but LinkedIn, it's just amazing that web is very powerful. That web of people, it's wonderful, actually, and very supportive. So yeah, you can find all the content there, or just go to bullseyebrief.com and read about what I do. In fact, I have a 45-day trial for $45 for anyone who wants to actually get to know the American Ingenuity portfolio in depth. That's probably the best way to do it.
Awesome. Adam, thanks so much. I really appreciate it. We'll see you again soon, and keep up the good work.
Okay. Look forward to it.
Thank you. That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to Wealthion.com and sign up for a free, no-obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. And if you could like and subscribe to the channel, we'd greatly appreciate it. Don't forget to hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching, and until next time, stay informed, be empowered, and may your investments flourish. And if you like this content, please watch this video next.